183 days is also used in two other aspects of law. And one is the foreign employment exemption, which is the exemption that has been amended from 1 March of this year, where one of the requirements is that you are outside of South Africa for more than 183 days. But that is only in relation to an exemption. It has nothing to do with your tax residency. Where we also see 183 days is in a lot of double tax agreements between South Africa and other jurisdictions. And that doesn't determine your tax residency, but often it allows you to claim tax residency of the foreign jurisdiction, but that does not cease your tax residency of South Africa automatically. So we must just be very careful. Tax residency is not determined based solely on number of days in and out of South Africa. In terms of our legislation, we've got two tax residency tests. One is the physical presence test, which looks at the amount of days you spend within South Africa, so the amount of days that you are physically present in South Africa. And there are 3 requirements to that. If you meet those requirements, you are considered tax resident under the physical presence test. However, there's also another residency test called the ordinarily resident test. And that looks at what is your intention. Is it to be a tax resident, or is it to be ordinarily resident of South Africa or not? And you need to have objective factors that prove what your intention is. Very importantly, because we've got 2 tax residency tests, you need to be considered non-resident under both tests to be considered a non-resident. If you meet the requirements of even one of the 2 tests, you would still be considered a tax resident in South Africa. And quite importantly, I get a lot of people that say, well, I haven't been in South Africa for the past 10 years, meaning, I haven't spent any time in SA, and therefore they're of the view that they are a non-resident. But that would only be the case in terms of the physical presence test. We still need to make a determination under the ordinarily resident test. And if you're a tax resident under that test, you are a tax resident of South Africa. Financial immigration is a process through both the South African Reserve Bank as well as SARS. And how it shows that you have ceased tax residency of South Africa is really under the ordinarily resident test, where it gives a very clear indication of your intention and a positive formal step forward to show that your intention is not to be in South Africa on a permanent basis. And you follow very certain guidelines with an application to SARS to show that you have broken your tax residency, including paying an exit tax. And that exit tax is only payable when you cease tax residency. And SARS requests this of you when you financially immigrate in the correct manner, which just shows that SARS is of the view that you are ceasing your residency. And when they are happy with that, they provide you with an immigration tax clearance certificate. Currently, it's the only formal process to cease your ordinarily residence in South Africa. If your intention is not to return to South Africa on a permanent basis, that is when you should cease your residency and financially immigrate. The rules around financial immigration are changing from 1 March 2021. So if you have already exited South Africa or are about to, my view is that you exit under the current financial immigration regime because it is a known process that works, rather than waiting to post 1 March 2021, where there is a new regime in place, which from the wording of the budget speech seems it will be more complex or more stringent, at least from a tax perspective. When you cease your tax residency in South Africa, no matter how you do it, there is something called a deemed disposal for capital gains tax purposes, and colloquially known as an exit tax, and it's dealt with in terms of Section 9H of the Income Tax Act. And this is very important because it's one of the formal steps you must take to show that you have ceased your residency. And basically, the exit tax is based on worldwide assets that you hold as at the time of ceasing tax residency. Not all assets are included. Very quickly, and on a base level, things that would be included in the exit tax are shares or unit trusts held worldwide, fixed property that you hold outside of South Africa, and potentially assets in a trust, depending on how the trust is set up and where you form part of that trust. There may be an exit tax. And things that are excluded from the exit tax are things like fixed property held inside South Africa, as well as retirement funding, like retirement annuity or pension or provident. Those would be excluded. And how it is dealt with is in the same way that capital gains tax is dealt with, meaning we look at your acquisition date of that asset and the value of that asset at that time, and that would be your base cost, versus the time that you cease tax residency, and that is looked at as though you have disposed of the asset as at that time, even though you're not actually disposing of it. That's why it's called a deemed disposal. And we look at the gain of the value of that asset, and you must pay your exit tax based on that, based on the standard calculations for capital gains tax.